We had the big rise in the dollar. Well, in the fourth quarter, we've had a big fall in the dollar. It hasn't lost all of its gains yet, but I think it will in 2023. But as the dollar weakens, that's also going to push up our trade deficits because it increases the cost of all of our imports. So I think the help that we got in Q3 was a one-off quarter. We may end up with a negative print for Q4, we'll see, but I think we're going to get quite a few negative prints in 2023 as more air comes out of this bubble. And then I think it's going to be very hard for the recession deniers to continue to put a positive spin on this economy. They're going to have to admit that we're in recession.
Inflation, which peaked at 9.1% in June, has further to rise in 2023, said Peter Schiff, chief market strategist at Euro-Pacific Asset Management, who correctly forecasted the 2008 housing crash and high inflation in 2022. We're not getting anywhere near 2% inflation, he said. Maybe we'll go below 7% before we go above 10%, but I think we're going to take out the highs from 2022 before the end of 2023 on a year-over-year basis. The Federal Reserve has hiked rates over the year by 425 basis points to rein in inflation, but Schiff said they could end up making this situation worse. Rising interest rates feed into higher consumer prices, he explained. If I am a business, I have to pay interest on my debt. Well, if interest rates go up, that's a cost of doing business. I might have to raise prices to cover that. Peter also pointed out that the entirety of the Q3 GDP increase was from a decrease in the trade deficit. It's not like inflation went away. It just got slightly less enormous than it had been. And that was for two reasons. The strong dollar enabled us to buy imports more cheaper. But also, all that oil that was released from the Strategic Petroleum Reserve, we got to export that, so that increased our exports and reduced our deficit. And so that helped us out. But those impacts are already starting to reverse. The dollar is tanking. And all of the economic data that's come out so far in the fourth quarter suggests that GDP in the fourth quarter is going to be negative again. As far as the petroleum reserves, Peter said we're going to run out sometime next year. Peter said that if he is right about the dollar going down, the price of oil will go way up. According to Peter, we've had the benefit of a strong dollar for the last year or two. So if you thought inflation was bad this year, wait until you get a load of it next year when we have a weak dollar.
Real reason that the dollar rose was not just that rates rose, but that the markets believed that these rate hikes were going to work, in that they were going to bring down the inflation rate. The Fed said that we're going to return inflation to 2%, and we're going to do whatever it takes to make that happen. And the markets basically took the Fed at its word. And so they bought the dollar on the idea that, these high rates were going to produce positive real returns for dollars. But I think as the markets come to terms with reality that despite the rate hikes, inflation is not going down to 2%. In fact, it's more likely to head higher after this, brief dip that we've had. And so that even though the Fed has raised rates are still negative from a real term. And if you have negative real interest rates, that is not a incentive to hold dollars. That's an incentive to sell dollars, because the interest that you earn is not high enough to compensate you for the purchasing power that you lose. And so when investors figure this out, I think the dollar is going to fall sharply, and that's going to exacerbate the problem that the Fed is dealing with, because the strength of the dollar limited the rise in consumer prices in the United States in 2022. So even though prices were up a lot, they would have been up even more had the dollar not been strong relative to other currencies. Well, if the dollar really weakens in 2023, that's going to add additional upward pressure to already rising consumer prices. Well, remember, all these countries were experiencing inflation. Most of the Eurozones, their inflation rates were higher than ours. I mean, they're still looking at, over 10% year-over-year inflation rates in many European countries. So all currencies were losing value. It's just that on a relative basis, it's like if I'm going backwards at 10 miles an hour and the car next to me is going backwards at 20 miles an hour, relative to the car going backwards at 20 miles an hour, I'm moving forwards. But I'm not moving forwards. In reality, I'm still going backwards. And so even though the dollar was strengthening relative to the euro or the yen, it was still losing value in real terms. Just it was losing value more slowly than the euro or the yen. I think the difference in 2023 is we're going to lose value more rapidly. So the euro and the yen will continue to lose value, but the dollar will go from losing value slower to losing value faster.
Amidst the strong dollar and speculations of lowering inflationary figures, Peter still argues that the recession will be a lot worse. In his words, I think the recession is going to get a lot worse. Now, that doesn't mean the Fed shouldn't be raising rates. They should be. They should have raised them a lot more than they have. The problem is they never should have cut them. That was the mistake. It was cutting rates. Raising them back up is just an acknowledgement of that mistake. But what happens is when the Fed raises rates, it uncovers all of the problems that it created when it reduced rates. Because when it slashed interest rates to zero, it inflated a bubble economy, and it inflated it with inflation. Quantitative easing was inflation.
Prices continue to go up. It's not like they're coming down. They're just going up a little more slowly than they were going up before. But if prices were too high, even a little increase is still a problem. What we need is for prices to go down. We need to, for prices to recover, or for consumers to recover some of their lost purchasing power by having consumer prices actually fall. But that ain't going to happen.
Right.
All we can hope for is that they rise more slowly. In fact, that's what the Fed's goal is. The Fed's goal isn't to reduce prices. The Fed's saying that we're hoping to reduce the annual increase to 2%. But those 2% increases are going to come on top of all the increases that preceded them. So if prices go up, I think over the last 2 years, they're up better than 15%, even the way the government measures them. In reality, they're probably up closer to 30%. But even if they start going up 2% from here, we're going up 2% from a much higher level, than we were at before. But of course, we're not going down to 2%. We're not even getting anywhere near 2%. Before we get close to 2%, we'll be above 10%. I don't know that the rate hikes had much to do with it, other than maybe they had something to do with the break in commodity prices temporarily. Because remember, those rising interest rates actually feed into higher consumer prices. Because people forget that, interest rates are prices, right? And so like any other price, they get factored in to finished goods. Like if I am a business, I have labor costs, I have raw material costs. Well, I also have interest rate costs. Maybe I borrowed some money to build a plant or whatever I'm doing. And so I have to pay interest on my debt. Well, if interest rates go up, that's a cost of doing business. Well, I might have to raise prices to cover that. Same thing if you're a landlord. What if I own a bunch of apartment buildings and I have debt on those apartment buildings? Yes, I have costs that I need to recover, but one of those costs is the interest on the money I borrowed. So I may have to raise rents on my tenants to cover the higher cost of servicing the money I borrowed to buy the apartment complex in the first place. So as the Fed is raising interest rates, that is also working to raise prices. Take a look at the example of houses. Yes, higher mortgage rates mean that house prices are going to come down. They've already started to come down. But the cost of owning a home is not going down. The cost of owning a home is going up. The cost of buying a home is going up, even if the price is down. Because when you buy a house, the price is not even that important for most people because they mortgage the price. They don't have the money. They have to borrow it. And even if the price goes down 10 or 20%, based on how much higher the mortgage rates are, it's actually more expensive to buy a cheaper house today because of your monthly payments. But your monthly mortgage payment is not it. What about your maintenance? What about your utilities? What about your insurance? These costs are going through the roof. So it's more and more expensive to own a home, to live in a home. These costs are going up, even if the price of the house goes down. And remember, during all these years where we supposedly had no inflation, real estate prices were going up. Well, during the rest of this decade, when we have high inflation, real estate prices are probably going to be going down.
In conclusion, every dollar that the government spends must be paid for by the public, one way or another. There are two ways the government gets money from the public. One is honestly through taxation, where it takes our money and then spends it. But the other way is dishonest. They just print money. They don't tax us. They print money, and then they spend that in circulation. But when they do that, the price of everything we buy goes up. And so instead of taking our money, they take our purchasing power. Every time you go to the supermarket and you're paying a higher price, you're paying a tax. Those higher prices are the cost of big government. And the more government spends, the higher prices are going to rise. Are you willing to sit back and just watch everything implode around you, or have you taken steps to save yourself and your loved ones from this impending doom? Let us know your course of action in the comment section below. Also, do not forget to like the video, subscribe, and turn on notifications. Thanks for watching.